Hello and welcome to today's premium account market update for July 2018. Any individual reading or listening should discuss with their financial planner or advisor the merits of any recommendation offered presented in this material for their own specific circumstances and realise that not all investments are appropriate for every individual. Presented today, myself, Leon Hine, Managing Director of Investor Signals, Licensed Securities and Derivatives Advisor. The format for today's presentation, we look at the F-year 18 earnings and F-year 19 earnings outlooks. We look at the technical trends, the portfolio allocations, and conclude with the short-term market outlook. The premium account service at Investor Signals offices, where we focus on a model portfolio of ASX top 50 stocks. We utilize options to enhance your portfolio returns. We're focused on effective ownership around ex-dividend dates, generating above average cash flow, as well as capital growth. It's a strict investment mandate, therefore suitable for self-managed super funds, and importantly, the assets remain in your name. If you'd like to know more about the premium account service, please contact us, Leon at investorsignals.com. Moving straight into a graph of the US equity market. Up on screen is the Dow Jones, with the average US PE valuation trading at around 16 times forward earnings, and the expectation that these June quarter earnings results will deliver around 20% EPS growth, largely supported by tax cuts and underlying growth of around 8%. The market's fair value is our base case. We think investors need to prepare for a longer consolidation period than probably what many are thinking. We think for the most part, the bullish uptrend of the market needs to pause, and we need earnings growth to continue to support the high PE valuation, especially in a backdrop where we've got the Federal Reserve starting to move interest rates higher. So as we roll through the top 50 stocks, the focus will be looking at the derivative overlay and the particular stocks that we think should sit inside investor portfolios at the moment. The XJO trades on a similar multiple, about 16, 17 times earnings. Underlying earnings growth expectations a little bit lower than in the US. We're looking for around 8% EPS growth domestically. We're naturally expecting big growth in the energy names and resource names, thanks to the rebounding commodity prices. With the index up here, we think that investors need to be mindful that we could see sort of a 5% retracement back down to 6,000 points. But for the most part, the market's reasonably well supported and should track mostly sideways. So with that, let's go into the top 50 and we'll roll through these, and I'll comment on the valuations and the stocks that we like. Now, AGL is not in the model portfolio. It has a lower low, lower high structure. We've seen earnings and price targets downgraded for AGL by most of the investment analysts, where the expectation was for AGL to grow earnings at around 12 to 14%. That number is going to be more like 8%. We have the stock now on a 5.5% forward yield into FY 19, which from a yield perspective, it's well supported. So to the extent that anyone is owning the stock, you should overlay a covered call, because we don't see too much capital growth over the next 6 months out of AGL. Aristocrat Leisure, very high PE and getting hard to buy this stock at 30 times earnings and a 1.9% yield. It is delivering double-digit earnings growth, close to 20%, but hard to get excited about buying that. Amcor, we continue to like this name. It was added to the top 20 index recently, and AMP was removed. The stock trades 17 times earnings on a 4.7% dividend yield. Forward earnings growth probably only going to be around 5 to 6%. We think this is a lull for Amcor. 2-3 years out, we expect the stock to be doing much better than it is today. AMP, not doing too much here at the moment, albeit it's probably approaching an oversold level. Now, it's important to recognise all the Australian banks have had a rebound of roughly sort of 8% from the recent lows. We think they're now running into resistance where they are at the moment, and for the most part, they move sideways. We're seeing the US banks reflect similar issues that our Australian banks have, and that's where loan demand is relatively low and banks are struggling to grow earnings. But in particular, Australia is sort of feeling that probably, I suspect, more than most banks globally. And obviously they have the issues stemming from the Royal Commission and having to rationalise their assets exit some of the international investments, exit some of the wealth management. So it's just hard to see over the next year or two where the Australian banks get the earnings growth that's needed to offset uh, the cost increases. In the case of APA, we've had a takeover bid here at $11 a share, and subject to foreign investment review approval, you'd assume that APA is good value here, and there is 10% upside into that takeover target price of $11. ASX, this has been a terrific financial stock where money's rotated out of banks and into ASX. The underlying earnings growth's been slightly better than the market expected over the last 6 or 12 months, where ASX was sort of growing earnings at around 3-4%. We've seen that pick up to about 6%, but the stock is trading on a very high PE relative to historical sort of measures. If you go back 5 years ago, ASX traded around 14-15 times earnings. It's now on 26 times earnings and a 3.4% dividend yield. So by any measure, it's getting expensive. Horizon, keep this on the radar into the back half of this year. We've seen the price adjustment that we were forecasting early or mid 2017. We were warning about the high payout ratio that Horizon had and some concerns around regulatory pricing impact on future earnings. Those issues have played out over the last 6 to 9 months. We had the algorithm sell signal up here at 550. The stock's still trending lower, but I think over the course of sort of late 2018, 2019, we'd expect to see this stock start to bottom out, and we'll watch for an algorithm buy signal and for that to be added into the model portfolio. BHP, we continue to like this name, albeit we don't see too much more upside for commodities. We think oil is fully priced here. Iron ore is going to find it difficult to move higher in an environment where global manufacturing is running at an 11-month low, and we have the tariff issues. So whilst BHP may achieve a better price outcome for their onshore oil assets in the US, we think that's mostly factored into the share price, and you want to be selling covered calls over BHP to complement the upcoming dividend. From a technical standpoint, we've watched the stock in 2015 and 16 in a downtrend, and then into late 16 and 17, the uptrends started to form, and the algorithm model's done a great job of keeping this stock in the model portfolio, and it's been one of the better performers. I have BHP on a 5% dividend yield, by the way. Brambles, we've got a recovery here from an oversold condition. The stock is not in the model portfolio at the moment, but we'll watch this over the back half of 18 and 19, looking to see a higher low formation build in Brambles, and we may see that added into the model. The stock's still relatively expensive at 18 times earnings and a 3.5% dividend yield, growing earnings at about 8% over the next 12 months. CBA, as with all the Aussie banks, we've got lower low, lower high structure. They're up against resistance. They've had a technical rebound from oversold conditions, but we don't see the catalyst for revenue pickup there. So a little bit cautious on the Aussie banks and just drawing your attention to the negative technical structure there. Cochlear has been a terrific performer. We see the history here of the higher highs and higher low formations, and the algorithm signal's done a great job of picking up these entry points. And for the most part, we're happy to take a look at Cochlear on the next pullback where we see that algorithm buy signal. Computer share, the last signal here was around $16.75. The stock's rallied up to $18.80. We think that's getting a little bit expensive. We have Computer share 22 times earnings and a 2.5% dividend yield. We're looking for the stock to pull back and test lower levels. CSL, now trading close to 40 times forward earnings on a 1.5% dividend yield, looking too expensive for us. Obviously a terrific business, and we're keen to buy it on the next pullback. Caltex, From a technical standpoint, the stock's broken down, made a lower low, rallied back up, formed a lower high. At that point, it was an opportunity to exit the stock or get aggressive with selling covered calls. At 14 times earnings and a 3.8% dividend yield, the stock's not expensive, so we're not looking for too much downside from where it is at the moment. And forward earnings growth probably something in the order of 2 to 5%. Dexter's not doing there at the moment. Fortescue, keeping in mind the broader comments on iron ore prices, where we don't think they're in an environment they're going to push too much higher, but on a relative basis, Fortescue's looking at a substantial discount to Rio and BHP, so maybe looking a bit oversold where it is at the moment. Goodman Group not there at present. GPT, a lot of these yield-sensitive names have rallied back up as we've seen US interest rates pull back. The pullback in 10-year bond yields is probably close to complete. We've seen it retrace from 3.1% back down to 2.8%. GPT's now at 16 times earnings and a 5% dividend yield. I think it's time to take profit on this or sell fairly tight covered calls to compound the cash flow. Insurance Australia Group, we like this stock, growing earnings at around, probably somewhere around 5 to 8%. Trades 18 times earnings on a 4.5% dividend yield. So it is expensive, and you want to be selling tight covered calls and stripping out the upcoming dividend, the franking credits. So buying the stock at these levels, selling calls at 8, sort of 25 or 8.50 at the most into the latter part of the year, you're driving around 10 to 12% cash flow, and we're looking for Insurance Australia Group to spend the most part of the next 12 months trading sideways. We don't think there's a whole lot of upside from a capital growth, but a good defensive opportunity to generate high cash flow for portfolios. James Hardie, exposure to the faster growing US housing market. James Hardie's growing earnings at around 20%. We've got the stock now on a 3% dividend yield. We've had the recent algorithm buy signal, and we're happy to buy the stock here, look for a little further upside, and then sell covered calls over James Hardie. Lendlease looking a bit expensive, trading around 3.5% dividend yield, and we're looking for a pullback to maybe around 17.50 before we look to add Lendlease back into portfolios. Not doing there in Mirvac at the moment. Medibank's been one of our preferred allocations in portfolios. We're fairly aggressive buyers of it down here at around this $2.80 to $3 range. As it pushes up here, I think it's an opportunity to sell covered calls. Again, turning sort of what would normally be a 4% dividend yield into sort of 10 to 12% cash flow on an annualized basis. To give you an idea on the valuation for Medibank, so at 19 times earnings and a 4.5% yield, we're not looking for too much in the way of revenue growth. Underlying profit growth will be probably mid-single digits at best. So our concern is that it's getting at 310 to 320, its full value, and we do recommend overlaying that covered call to enhance the return. Macquarie, we've seen underlying earnings growth increase from sort of 2.1, 2.2 billion up to 2.5 billion over the last 12 months. That puts Macquarie on a PE ratio about 17 times earnings and a 4.5% dividend yield. And therefore, we just form a view that it's probably fair value. And again, this is a name that we're waiting for a pullback on a weak market before we add that back in on the next algorithm buy signal. NAB, we've seen this removed from the model. It shifted into a sell signal back in February when it formed the lower low, lower high at $30. The stock since sold off down to $25 or $26, had a minor rebound. It's filled the price gap up to around 28.30. Our view on all the banks is not too dissimilar. We think they're up against resistance where they are at the moment and not looking for really any upside. Still, probably the risk is more to the downside. Newcrest had a lower low, lower high algorithm sell signal at around this $22 level. Just mindful that it sits under resistance at $22.50, and we're really looking for the price to reverse higher, break through that $22.50. It's been in this consolidation range now for more than 2 years. More often than not, from a technical standpoint, when a stock enters a consolidation range from moving in an upward trajectory into that consolidation, it'll often leave in that same direction. So, but where it stands at the moment, we're just aware that it's had this double top at 22.50 and a little bit cautious while price struggles below that. Origin Energy, we really like this company. We've seen earnings increase substantially, and we've seen the company do a good job of paying down debt. At 17 times earnings, we're looking for a reinstatement of the dividend at the August earnings result. Based on those forecasts in F year 19 and F year 20, we have the stock starting to trade on a yield of around 4-5%, and that makes it sort of fair value where it is at the moment. We think it's likely to consolidate for quite a number of months before moving higher again. So this is an opportunity for where you own Origin to sell covered calls and try to drive that 10% cash flow and allow moderate capital growth from where it is at the moment. Orica, not doing here at the moment, just making you aware that it's under algorithm sell conditions at the moment. Oil Search, we like this name. There were 2 oil stocks that were added into the model portfolio in February this year. One was Oil Search, one was Santos, and they've both performed exceptionally well. At the moment, Oil Search is probably looking a little bit stretched from a valuation standpoint, and we look for a pullback and then an opportunity to add that into portfolios. Qantas, it's in the model portfolio. It's been a good performer, making higher highs and higher lows. We do have some concerns as the fuel hedging rolls off and what Qantas. The other point just on Qantas is the aging of their fleet. The normal aging history of the planes is around 7 years, and I think they're now, that average is pushing out to about 10 years. So from what I've read, I understand that their portfolio, they've obviously saved money through extending the replacement cycle of the fleet. So I think maybe there's just a couple of concerns there. One, what does it look like with fuel hedging coming off? What does it look like in 2, 3, 4 years out if they're having to increase spending on new planes? So just something maybe just to have a think about there with Qantas. QBE Insurance generally is going to be a beneficiary of a stronger US dollar and also higher bond prices. We've had the stronger US dollars, but the bond price, well, the yield on bonds has actually softened. We still have the technical structure here of lower lows and lower highs. So again, it's one of those stocks that it's not until we get out into the back half of 18 or early 19 that we may start to see a higher high and higher low pattern, at which time we get attracted to QBE. Ramsay Healthcare, so we've seen this name adjust from very high PEs where Ramsay was trading up at around sort of 26 times earnings. It was only on less than a 2% dividend yield. We've seen the stock price fall from $82 thereabouts down to $55. We've seen the earnings fall from around 8% expected earnings growth down to 5% earnings growth. They are in the middle of a takeover offer to expand their European hospital portfolio. That bid was rejected on the weekend, and we'll sort of stay tuned to see how that unfolds over the weeks ahead. But at the moment, we have Ramsay at 19 times earnings and a 3% dividend yield, so certainly starting to look more attractive. And you'd have to assume between sort of $50 and $55 the stock forms a base here and should provide a good buying opportunity. Rio, we're encouraged with Rio as a result of their asset sales and the probability of them returning excess capital to shareholders over the next 6 to 12 months. So our view here on Rio is that, yes, we're mindful that there's probably not the catalyst to drive iron ore prices higher. So we assume that Rio moves mostly sideways for the next 6 months, and you want to be selling covered calls over the top to help compound that return. South 32 was recently added into the model portfolio here at 350. If we look at the history of the signals, it was last added in February 2017, delivered roughly a 50% gain between the buy signal and the following sell signal, had a shallow retracement, and then it's been added back into the model. As the stock pushes up to around 370, we look to sell covered calls over South 32. Centre Group, this is getting expensive. It's rallied off the back of a number of analyst upgrades. Bond yields pulling back, so these yield-sensitive names start to look a bit more attractive. But at 18 times earnings and a 5% dividend yield, only about 3% underlying earnings growth, we think Centre Group's full value there at the moment. Stockland's reaffirmed their earnings guidance for 6 to 8%. But you can see here the market's still cautious on any of these companies that are tied to the residential housing market here in Australia. And we've seen Stockland's create lower lows, lower highs. It seems unlikely that the stock rallies back and takes out this 436 high. So maybe it has 6 months of consolidation, but not sure there's a catalyst in the short term for it really to push too much higher. Sonic Healthcare, we think this is getting expensive at 23, 24 times earnings, 3.5% dividend yield. Forward earnings growth is only likely to be around 7%. So we'll take a look at this on the next major pullback and the algorithm buy signal. Santos, we like Santos making higher highs, higher lows. We've seen them knock back a takeover bid for $7 or $7.25 per share around a month ago. So the company feels confident that they can deliver better value than that outcome for shareholders. And just with this current weakness that we're seeing in energy prices, we think this creates a buy opportunity for Santos. So somewhere between 6 and 5.50, we look for it to create another higher low. Suncorp, expensive up here, trading around 19 times earnings on a 5% dividend yield, but we think sort of the good news is priced into Suncorp there. Sydney Airports was added into the model portfolio last week. The stock trades on a 5% dividend yield, probably deliver somewhere around about 8% earnings growth. Owning it here, selling a covered call above the market, allowing for moderate capital growth, you're turning a 5% dividend yield into 10 to 12% cash flow. So we see a space for Sydney in portfolios at the moment. Transurban, similar type of outcome where you got around 5% dividend yield, around about 8% underlying, 8 to 10% free cash flow growth, which is supporting an increase in the dividend from sort of 50 cents to around 55 cents on a full year basis. So if we go out into FY19, that's where we get to Transurban trading on just over a 5% dividend yield. But we think that's fairly expensive. And again, you want to be selling a covered call, allowing for moderate capital growth and turn that 5% yield into something more in the order of 10 to 12%. Telstra just starting to show some life in the last few days. There is good news on the horizon. So as the company separates their infrastructure assets from their retail arm, internally that's being done at the moment, and the separated division is called Infrastructure Co. But as a shareholder of Telstra, you won't see the finalisation of that separation probably for another 2 years, and you'll end up as a shareholder in both of those entities, and that should help to unlock shareholder value. For the moment, from a technical standpoint, the stock's still making clearly lower lows and lower highs. So again, if we go out into the back half of 18 or early 2019, we may well start to see the beginning of a higher low structure there for Telstra, which will be welcomed by all shareholders. Treasury Wines, terrific technical structure here, one of the better performing stocks in the model portfolio. We think it's just getting a little bit expensive at the moment at 36 times earnings and just over a 2% dividend yield. The market is looking for earnings growth in something around 25 to 28%. We'll just sit on the sideline with this one and wait and see what the upcoming earnings result looks like, and then we'll reassess where fair value is. Unibail Rodamco, so this is the spin-off, or I shouldn't say the spin-off, this is the entity that's taken over Westfield. The issue here for Unibail is new money coming into the market. There are some tax considerations with it being a offshore entity. And for that reason, we're not doing too much here in Unibail at the moment. There's other real estate investment trusts that we are more attracted to at the moment. Westpac, similar to the other banks, lower lows, lower highs, up against resistance at the moment. Wesfarmers, looking expensive. We've seen in the media that where Wesfarmers, or in particular their Coles division, seems to be winning back market share uh, at the margin from Woolworths. But the market's excited here about the prospect that in early 2019, Wesfarmers is going to spin off Coles, and as a shareholder, you'll end up with shares in what is predominantly the Bunnings aspect of Wesfarmers, and then obviously a separate entity there with Coles. Generally, when these companies spin off these businesses, they have a more disciplined approach to running the companies and helps to unlock some shareholder value. We think the most part of that optimism is now priced into Wesfarmers, and you're probably better off taking profit here and having a look at rebuilding positions in both Wesfarmers and Coles post the breakup of the companies. But to give you an idea of a valuation where we see Wesfarmers at the moment, it's on 20 times earnings. It's come down from 5.5% yield down to about 4.5% yield. And we may see fairly low levels of growth for Wesfarmers in the upcoming earnings result, maybe only around 4 or 5% at best. Woolworths getting expensive here. So when you look at the PE valuation of Woolworths, 24 times earnings on a 3.3% dividend yield. So we wait for this to pull back and the next algorithm buy signal before that's added into the model portfolio. Likewise, at Woodside, we think that's getting a little expensive. We're looking for a pullback there over the coming months. And there we are back to the index. So just to conclude, when we look at the model portfolio, and if we just jump in here and have a quick look at the ASX 50 and look at the stocks that are actually in the model portfolio. So at the moment, there's about 18 names that are in the model. So just going through those, there are a lot of the names there that we've obviously covered tonight. I've tried to highlight the ones that we're still bullish about, and I've also highlighted the ones where we think there's limited capital growth and it's about selling covered calls and stripping out the dividends. If we go down and have a look at the historical performance of the stocks that have been closed out from the model portfolio, so it shows you the percentage gain as a result of the algorithm model triggering the entry level and the exit level. And then the idea is that on a select basis, we can overlay the covered call strategy to enhance the cash flow further from those top 50 names. The index here at the moment, the top, we might just bring up the XJO actually rather than, so to look specifically at the numbers on the XJO, we have support at 6174. We think that the market's likely to come back down and test this, and if we see that level fail, we could be looking for a move back down to around 6,000, but we don't see those moves in the market as particularly concerning, and on a bigger picture basis, the market's likely to mostly move sideways, and investors should be thinking about using the derivative overlay to enhance the portfolio returns. And if you'd like to know more about that, please feel free to email me, leon@investorsignals.com. Thank you.